Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. Today's video is on a partnerships question. This particular question is from October-November 2024, paper 2 variant 3, and one of the parts of this question is to prepare a capital account for one of these partners. So that is the differentiating point about this question. Also, someone requested me to make a video on this particular question in one of my live streams. So here it is. Ali and Sai are in partnership. Their financial year ends on 30th June. Their partnership agreement includes the following items. Interest on capital is allowed at 6% per annum. Interest on drawings is charged at 5%. Sai is entitled to a partnership salary of 10,050 per annum. Ali and Sai share residual profits and losses in the ratio of 3:2. Ali and Sai have provided the following information. They've given you drawings for the year ended 30th June 2024. For Ali, it is 11,000. For Sai, it is 16,000. Capital at start. For Ali, it's 60,000. For Sai, it's 40,000. Current account balances at start. There's a debit balance for Ali and there's a credit balance for Sai. Then they're saying the profit for the year before interest on loan is 42,700. Ali provided a loan to the partnership of $10,000 at an interest rate of 5% per annum. The interest payment for the year ended 30th June 2024 had been made. The partnership has no other loans. Okay, so they have paid the interest to Ali on the loan that Ali has provided to the partnership. So what is the interest that they were supposed to pay, and what's the amount of the interest that they have paid? So 10,000 multiplied by 5% will give me $500. This is the interest that they were supposed to pay, and the profit before interest. So profit before interest is 42,700, and when we subtract interest from this, so this 42,200 will be my profit for the year, because interest, whether it is from the partner or loan, whether it is from the partner or it is from a bank, the interest payment is recorded in the income statement expenses section of the income statement, and same goes for interest on loan from a partner and interest from loan from a bank. In both cases, interest expense should be subtracted in the expenses section of the income statement, and then basically we get the profit for the year, and this profit for the year will be taken to the appropriation account. So 42,200, we are supposed to take 42,200 to the appropriation account. They're saying the partnership has no other loans. So when they are asking you in the first part, they're asking you prepare the profit and loss appropriation account on page 7 for the year ended 30th June 2024. Okay, so this is pretty simple. We'll start with profit for the year. So I'll write here profit for the year, and I will write here 42,200. Then I will write here add interest on drawings. Add interest on drawings. So interest on drawings is charged to the partners because they are withdrawing money from the business. So we basically add this to our profit and increase our profit with interest on drawings. So for Ali, I will write here Ali, and you guys are supposed to write the full names of the partners. So that is, don't write the initials of the partners, just write the full name of the partner. In this case, partner is Ali. So Ali has withdrawn $11,000 from the business, and 5% is the rate of interest that we are supposed to charge to Ali because he has withdrawn $11,000. So 11,000 multiplied by 5% will give me 550. For Sai, I will write here Sai. I'll write here 16,000 is what Sai has withdrawn from the business as drawings, and then 16,000 multiplied by 5% will give me 800. So this is basically my interest on drawings. So basically I have taken drawings for the year ended 30th June 2024 from this question, and for Ali it's 11,000, for Sai it's 16,000, and I have applied the percentage of interest. Interest on drawings is charged at 5% per annum. Now this is going to be, the total of this is going to be 1350. When I add 42,200 with 1350, I will get here 43,550. So yes, I will get 43,550. So 1350 plus 42,200, 42,200 plus 1350 will give me 43,550. Then I'm supposed to subtract certain things, so less interest on capital, because interest on capital is given to the partner. So I'll write here less interest on capital. Then I will write here Ali. Ali is given the interest on capital, so the capital capital account balance for Ali at start is 60,000, and the same is the balance at end also. So 60,000 multiplied by 6% will give me 3,600. And for Psi, I will repeat the same calculation, but the capital amount is different for Psi. 40,000 multiplied by 6% will give me 2,400. And then I'm supposed to give a salary to Psi. So I'll write here salary, I'll write here dash Psi, I'll write here 10,050. This salary will be given to Psi. So 3,600 plus 2,400 plus 10,050. So 3,600 plus 2,400 plus 10,050 will give me 16,050. So 16,050 when it is subtracted from 43,550. So 43,550 minus 16,050 will give me 27,500. This we need to divide into the profit sharing ratio. So I'll write here profit shares. I'll write here Ali. Ali's profit share will be 3 divided by 5 multiplied by 27,500, and Sai's profit share will be 2 divided by 5 multiplied by 27,500. So for Ali, the profit share will be 16,500. 16,500, and for Sai it'll be 11,000. So Sai's profit share is 11,000. Now 16,500 plus 11,000 is 27,500. This is going to be my profit shares. So that's it for the appropriation account. In the next part, they're asking you to prepare a capital account. So now I will basically differentiate for you guys what a capital account for sole trader looks like and what a capital account for partnership looks like. So if you look at the capital account for a sole trader, this is the capital account for a sole trader. So this is a single person for whom we are preparing a capital account. This balance brought down represents the capital at the start of the year. Bank represents the money that you're the additional capital that we are investing in the form of like by credit transfer, or the amount that we are transferring from our personal bank account into the business bank account represents bank. So we can also invest the money in cash. So whenever we invest money in cash, we do with the double entry is cash debit capital credit. Whenever money is transferred to the business bank account, the double entry is bank debit capital credit. Also, the owner can bring a non-current asset, a personal non-current asset into the business, and if it's a motor vehicle, the double entry will be motor vehicle debit capital credit. And if it's, let's say, a computer equipment, you can say computer equipment debit capital credit. So when the owner transfers their personal non-current asset into the business, that is what the double entry is going to be. During the year ended, whatever profit is made, you need to write it on the credit side of the capital account. So profit for the year is written on the credit side of the capital account. Okay, so in some marking schemes, they've written income statements. So that means whatever profit we have made during the year, we transfer the income statement value into the capital account, because profit always increases capital, right? So capital account, the rule for capital account is that it increases on the credit side, decreases on the debit side. And whenever we make a profit, capital increases, so we'll record that on the credit side of the capital account. Then drawings, whatever drawings we have, both goods plus cash drawings, need to be written on the debit side of the capital account, because drawings reduces capital. If it's a loss, so there can be a profit or there can be a loss. Both of them cannot be together. So in one question, you can have profit for the year, or you can have a loss for the year. So if you don't have profit, you will have a loss. So loss for the year will be recorded on the debit side of the capital account. So that means capital will decrease because of loss for the year. Then we have a balance carried down, which is the closing capital at the end of the year. So capital at end is basically the balance carried down. So this is for a sole trader. Okay, so sole trader, whatever profit is made, is recorded in the sole trader's capital account. And whatever drawings they take out, or whatever changes are made during the year, so even additional capital is recorded in the sole trader's capital account. All the changes are basically recorded in the sole trader's capital account. However, in case of a partnership, capital account stays fixed, so it stays fixed. And for capital account, only permanent increase in capital. So only permanent increase in capital is recorded in the partner's capital account. So I will tell you what does only permanent increase in capital mean. So permanent increase in capital means that if the partner brings more capital, additional capital, or let's say the partner brings in a motor vehicle, personal motor vehicle, and transfers it into the business, or transfers any other non-current asset, personal non-current asset into the business, or brings additional capital in the form of cash or in the form of bank, only that will be recorded in the capital account of the partner. All the other changes, that is profit share, let's say, or interest on capital, or interest on drawings, all of them are recorded in the current account of the partner, not in the capital account. Only capital account will stay fixed. Only and only permanent increase in capital will be recorded in the capital account. So when we make the capital account here, we'll write here July 1, and then we'll write here 2023. This is the start of the year. I'll write here balance brought down. I will write here 40,000. This is my opening balance for size capital account. This I have taken from the question, 40,000. And now if you look at the question, there is no permanent increase in capital. There is no additional capital in the form of a non-current asset, or in the form of bank, or in the form of cash. There is no additional capital in this question. So you guys will make the balance carried brought down, your carried down. So I'll write here balance carried down. I'll write here 40,000. This is going to be my capital at the end of the year also. So I'll write here June 30. I'll write here 2024. I'll balance this account at 40,000 on both sides. 40,000 on both sides. And then I will bring this balance carried. I'll make this balance carried down, my balance brought down. I'll write here balance brought down. I'll write here 40,000. This is also be my capital. This will also be my capital on 1st July 2024. So at the start of at the start of 1st July 2024, my opening balance on capital will be 40,000. So that means size capital account is staying fixed in this case. There is no change in capital. There was no additional capital. There was no additional non-current asset, personal non-current asset of size brought into the business. So capital account will stay fixed. In the current account, however, we'll put all the changes that we need to put. So our current account balance for Sai is 250 credit. So I'm going to write this on the credit side because it says it's a credit balance. I'll write here balance brought down. I'll write here 250, and this is going to be July 1, 2023. This is going to be my balance brought down of my current account. Then we need to record whatever there is in the appropriation account, important stuff. Interest on drawings needs to be recorded on the debit side of the current account. So let me record this. I'll write here interest on drawings. So since it's a T account that I am preparing, I am supposed to write full forms of everything. Please avoid writing short forms. Even for balance brought down, write BALANCE B/T. For interest on drawings, write the full thing. This will be June 30th. So I will write here 30th June 30, 2024. Then for drawings, so we also have drawings on the debit side of size current account, and drawings were 16,000 as per the question. On the credit side, I'm supposed to write interest on capital. So I'll write here interest on capital. And I remember from my appropriation account, interest on capital for Sai was 2,400. So I will record this on the credit side of Sai's current account. I'll write here 2,400. Then Sai was given a salary. So I'll write here salary. I'll write here 10,050. Sai's salary is 10,050. And then Sai's profit share needs to be recorded in Sai's current account. So profit basically increases your capital, so that needs to be recorded on the current account of current credit side of the current account of Sai. So I'll write here share of profit. I'll write here 11,000. Now for the debit side of my current account, total is 16,800. The credit side of my current account is 23,700. So I'll get a balance carried down. So I'll write here balance carried down, and this balance carried down will be 6,900. So how did I get my balance carried down? 23,700 minus 16,800 will give me 6,900, which is my balance carried down. I'll write here June 30. I'll write here 2024, and this T account will balance at 23,700 on both the sides. I'll write here 23,700 on both sides. Then this balance carried down will become my balance brought down. I'll write here 6,900. I will write here July 1, 2024. This is going to be my balance brought down on July 1, 2024 inside current account. So that's it for current account. Then they are saying state two disadvantages of operating as a partnership. Okay, so you just have to state two disadvantages. You don't need to explain them. So you need to write, okay, one of them will be that disagreements between partners can occur. So disagreements between partners can occur. And then you need to write, okay, you can write profits need to be shared. So profits will have to be shared. So profits will have to be shared. Also, any decisions taken by the partnership needs to be recognized by all partners. So even if one of the partners has taken a decision, obviously they will discuss it with the other partner and take that decision. But then that decision needs to be recognized by all the partners. So that is also a disadvantage, because if it's a wrong decision, or if it's a decision that is leading to a very negative consequence, but all of the partners should recognize that decision. In the last part, they're saying prepare the journal entry to record the payment of interest on loan provided by Ali. A narrative is not required. So if interest has been paid, right? So bank will be credited, of course, because this transaction will go through the bank, right? Because payment of interest will be made from the partnership bank account. So you will credit the bank account and you will debit loan interest. So we'll debit loan interest because expenses are always debited. Loan interest account will be debited and bank account will be credited. However, so expenses are always debited. That is why I'm debiting loan interest. Whenever we are making a payment for expense, we record that on the debit side of the expense account and on the credit side of the bank account, of course, because money is going out of the business. However, if there is this loan interest, the loan that was provided by Ali, if that interest was not paid, if the whole thing was owing, let's say, so if the loan interest was owing, we would have done loan interest account debit, and we would have recorded this in the current account of Ali. So Ali's current account would be credited with the interest amount, because the reason is that whenever interest is, let's say, the expense has been incurred but we did not pay for Ali's interest, right? So if in that case, if we haven't paid for Ali's interest, we will just increase their capital. Instead of making the payment, like we did not, because we did not make the payment, but we have used that loan. So because we haven't made the payment, we will record this on the credit side of Ali's current account, and we'll increase current Ali's capital instead. And in a normal case, if it was a bank loan and the interest would have been incurred but it wasn't paid, right? So the amount owing would have been recorded in the other payables section of the statement of financial position. In the current liabilities section, it would have been written as other payables. But if it's Ali's loan, because Ali is a partner and Ali is providing a loan to the partnership, this guy, because since he's a partner, and if his interest is owing, if it's not paid to him, then you need to credit Ali's current account and increase Ali's capital instead of, because we did not pay the interest to him. So we will record that on the credit side of Ali's current account, and that will not be a liability anymore. You will just record that as capital. So Ali's capital will increase instead, and we'll not record that as other payable, because this is a partner's loan. If it was a bank loan, we would have recorded, and the whole thing was owing, we would have recorded it as other payables in the statement of financial position. So that's it. Thank you so much for watching. Hope this helps you guys. Thank you so much.